Hello derivatives class, my name is Roman Losif and I will be presenting with Sydney Stanton review of the article by Owen Johnson and Mark Rogerson from CME Group. The shift from Eurodollar to SOFR is accelerating. This article was posted and paid for by CME Group on Reuters on November 8, 2021. And now I'm going to pass it on to Sydney.
Thank you, Roman. So, what is SOFR? The Secured Overnight Financing Rate is a broad measure of the cost of borrowing cash overnight collateralized by Treasury securities. The SOFR is calculated by taking the volume weighted median of transactions in three markets for repurchase agreements collateralized by U.S. Treasury securities.
The article points out that the pace of transition to U.S. Interest rate benchmark (SOFR) has picked up dramatically. The global regulators encourage markets participants to transition to SOFR ahead of the scheduled discontinuation for the U.S. dollar LIBOR rate after June 30th, 2023. CME Group launched SOFR-based futures in 2018 to support the transition, and they have proven to be one of the CME's most successful ever product launches. Over 600 customers have traded SOFR futures to date, and activity level in 2021 year to date are 200% higher than the same period in 2020.
SOFR futures are growing fast, but the products are still in their infancy, at least relative to 3-month Euro-dollar futures. However, the balance of US dollar rates, futures, and options exposure has begun to favor SOFR. This is in part because of the announcement by CME Group that any Euro-dollar exposure where the start date is beyond June 30th, 2023, will automatically convert to the corresponding CME SOFR futures, plus a fixed spread of 26.161 basis points. The spread between 3-month SOFR futures and Eurodollar futures for the months beyond June 2023 are trading in a very tight 26 to 26.5 basis point range, which closely reflects the fixed fallback conversion spread of 26.161 basis points. Before June 2023, the spread is much more dynamic.
Over 46% of the total current Eurodollar futures open interest is tied into a post-June 23 LIBOR. This means that they will convert to SOFR positions if held until LIBOR expiration in June 2023. CME has announced a similar conversion methodology in the options market, where options on the Eurodollar futures convert into options on corresponding SOFR futures at the same time as the scheduled Eurodollar future conversion. The increased adoption of SOFR in the over-the-counter OTC markets in recent months, SOFR trading increased 78% in August because SOFR futures in the SOFR-linked Eurodollar market is expected to provide liquidity for fast-growing needs in marketplace. The success of the transition of SOFR in the futures and options market shows how comfortable the market has become with the SOFR, and it's a powerful indicator of still greater take up on the new benchmark in the OTC markets.
With that being said, why is SOFR accelerating? CME Group's SOFR futures and option contracts have seen rapid acceleration and exponential growth as the market continues to move away from LIBOR. Companies, banks, and traders claim to pick SOFR in part because of its stability during the COVID-19 market swings. It demonstrated that it's robust enough to support large numbers of financial arrangements. Traction has been gained since the December 31st deadline that prohibited U.S. banks from issuing new debt tied to LIBOR.
So, in the summary, what does this really mean to us? What is this article telling us? Uh, and it seems like what the article telling us is that industry is really kind of like kicking the can down the road to perform the transition. It's been like 2 years in the making, and CME Group has decided to finally draw the line in the Senate and call June 2023 the date of the transition. There are many stories that we can relate to having to resist the change, and those would include those stories that situations we know were the change even for the better. Um, However, people still tend to resist because they resist the change. the markets are comprised of the people who are used to LIBOR, and they will resist the change. They're familiar with LIBOR, and this is something that they dealt all the time. Now, as they transition to a new SOFR rate, they will need to learn new things about the SOFR and the rules, how to figure it out and how to apply it. And they're less comfortable with that. However, as the time goes by, and new people, students like we are, will take the place of the ones who resist in the change in the industry, and we will lead the adjustment to the new rates. With the lessons learned in the class, we're better positioned for these adjustments in the constantly evolving industry.
Thank you all for listening to our presentation. Any questions can be asked below and we'll be sure to answer them.